Every empire in history seized power through the same playbook. Armies, navies, territory, resources seized by force. But in 1999, one country discovered something more powerful than any of those, a financial mechanism so subtle, so deeply embedded in the architecture of the global economy, that 25 years later, the entire world depends on it continuing to function. No invasion, no declaration of war, no treaty signed under pressure, just interest rates. And right now, in March 2026, that mechanism is beginning to crack. And what happens next will determine the financial fate of hundreds of millions of people who have never once thought about Japan. 3 days ago, a quiet room of 9 Japanese bureaucrats made a decision that controls whether your retirement account goes up or down this year. You didn't vote for them. You've never heard their names. But when one of them dissented, calling for an immediate rate hike, global currency markets moved within minutes, not because of the Federal Reserve, not because of Wall Street, because of Tokyo. Most people spend their entire investing lives watching the wrong city. The real power in global finance isn't in Washington or New York. It's in a central bank building in Japan. And what happens there in the next 12 months will determine the fate of your mortgage rate, your savings, and the global economy more directly than any decision made anywhere else on Earth. Here's why, and here's the data that proves it. Let's start with the mechanism, because once you understand it, everything else becomes obvious. For over 2 decades, Japan kept its interest rates at essentially zero, the cheapest borrowing environment in the history of modern finance. Foreign investors quickly discovered they could borrow unlimited yen at near zero cost, convert it into dollars, and invest in higher yielding American assets. The profit was the gap between what they borrowed at and what they earned. It was, for all practical purposes, free money, and the world took as much of it as it could carry. Today, in early 2026, a US-based hedge fund can borrow the equivalent of $100 million in yen at just zero. 75% for a single month, convert it to dollars, and park it in American assets, earning 5, 6, or 7% annually. The math still works, barely, because despite Japan's recent rate increases, the yen has continued to weaken against the dollar, which keeps the trade profitable by offsetting higher borrowing costs. But the margin of safety is collapsing fast, and the size of the position sitting on top of that collapsing margin is almost incomprehensible. The outstanding value of yen forwards held by global hedge funds and principal trading companies alone reached $135 trillion as of late 2025. When you factor in the full universe of forwards, foreign exchange swaps, and currency swaps, the total value of positions dependent on the yen carry trade hits $281 trillion. That is the scale of global investment directly dependent on Japan maintaining cheap borrowing conditions. When Japan changes its rate policy by even a fraction of a percent, trillions in leveraged positions around the world are forced to react simultaneously. Once the yen begins appreciating meaningfully, the move is likely to be outsized precisely because of how enormous the trade has become. This is not a theoretical future risk. It is not something analysts are warning might happen someday. It is happening right now in real time, and the data from this quarter makes that unmistakably clear. In the first quarter of 2026, the status of the yen carry trade can best be described as fragile. We are not seeing a total collapse, but we are witnessing a controlled unwind, with large hedge funds having already begun deleveraging their yen positions. The Bank of Japan has been forced to move its short-term policy rate toward Common 1, 0%, which still sounds low by global standards, but represents the highest cost of borrowing in Japan in nearly 20 years. For the yen carry trade, every fraction of a percent increase in Tokyo reduces the margin of safety for global speculators who built their entire position on the assumption that borrowing would remain nearly free forever. And the connection to global equity markets is now mathematically undeniable. In 2026, the correlation between a strengthening yen and a falling stock market has tightened significantly. The USD-JPY exchange rate has become as important a leading indicator for investors as the Federal Reserve's own policy statements. Think carefully about what that means. The exchange rate between two currencies, one of them not even American, now predicts U.S. stock market moves more reliably than the central bank that controls American monetary policy. That is how deep Japan's financial influence has become. Major research houses have called the carry trade a ticking time bomb, warning it is vulnerable to a massive unwind similar to the collapses seen in 2008, 2015, and 2020. The difference this time is the sheer scale of the position. In those prior episodes, the trade was a fraction of what it is today. The bomb is bigger and the fuse is shorter, and the alarm bells that started ringing in January have only gotten louder since. In early January 2026, the benchmark 10-year Japanese government bond yield briefly touched its highest level since 1999. That was January. By this week, March 23rd, 2026, things have moved further still. Japan's 10-year bond yield has risen above 3%, marching toward multi-decade highs as the ongoing conflict in the Middle East and surging oil prices add new inflationary pressure. The longer end of the curve is even more dramatic. Japan's 30-year bond yield now sits at 53%, up nearly a full percentage point from just 1 year ago. The 40-year bond yields 55%. For a country that spent a generation at zero, these numbers represent a seismic structural shift in the global interest rate environment. These numbers matter because of what rising yields cost Japan's own government, and the brutal trap they create. Servicing Japan's national debt rose more than 10% in the fiscal 2026 budget, surpassing Y-31 trillion for the first time ever, the sixth consecutive record high. The total outstanding government bonds are predicted to reach Y1, 15 quadrillion, by the end of this fiscal year. Japan is the most indebted developed nation on Earth, carrying a debt-to-GDP ratio of 237%, second only to Sudan among all nations globally. And that ratio is only going higher as borrowing costs rise on a debt pile of this magnitude. Raise rates to control inflation, and the interest bill explodes. Keep rates low to manage the debt, and inflation keeps burning, and the currency keeps weakening. Japan is caught between two catastrophes, and every policy decision it makes sends shockwaves through global markets the moment it is announced. Now add the lever that gives Japan direct influence over the United States government itself. As of January 2026, Japan holds $225 trillion in U.S. Treasury bonds, making it the single largest foreign creditor of the United States, ahead of China, ahead of every other nation on Earth. American taxpayers write billions in annual interest checks to Japanese institutions, but the real power is not the interest. The real power is what happens when Japan's own bond market starts offering better returns than American treasuries. Right now, 10-year Japanese government bonds offer higher yields than currency-hedged 10-year U.S. Treasury bonds. When Japanese bonds pay more than hedged American debt, Japanese institutional investors, pension funds, insurance companies, banks managing trillions in savings, stop buying American debt and bring the capital home. The return of Japanese capital from foreign markets back to Japan is a scenario widely predicted by analysts for 2026, as decades of offshore investment slowly reverse course. Even modest rebalancing flows at the margin can move U.S. Treasury yields meaningfully, particularly when global positioning is crowded and volatility is elevated. It is the actions of marginal sellers that drive price movements in bond markets, not the average. And when Treasury yields rise, mortgage rates rise, car loan rates rise, business borrowing costs rise, the entire American credit market reprices upward, not because the Federal Reserve made a single decision, but because Tokyo did. A steeper yield curve in Japan forces European and American curves to follow. It is an interconnection that most retail investors have no awareness of, and most professional investors are still underestimating. Into all of this walks a new political figure that the financial world is still calibrating. Prime Minister Sanai Takaichi won the Japanese elections on February 8, 2026, with an overwhelming majority, 2/3 of the lower house, carrying a mandate for massive government investment in technology, semiconductors, and defense, all in the context of a regional security environment made more volatile by the war in Iran. Her government is spending at a pace Japan has never seen. The fiscal 2026 budget of Y122. 3 trillion is the first to exceed Y120 trillion, and a record high for the second consecutive year. Defense spending alone reached Y109 trillion, hitting the 2% of GDP target 2 years ahead of schedule. More spending means more bond issuance. More bond issuance means more upward pressure on yields. More upward pressure on yields means a faster acceleration of the exact carry trade unwind that the world is trying to manage carefully and quietly. But here is where the political collision becomes truly dangerous for global markets. Takaichi needs cheap borrowing to fund her record spending agenda. That puts her in direct conflict with the Bank of Japan's inflation-fighting mandate. After her landslide election victory in February, she expressed her reluctance to the BOJ governor about raising interest rates further. You now have a prime minister demanding low rates to fund historic government spending on one side, a central bank that has been signaling continued normalization on the other side, and a $2,281 trillion yen derivatives market watching every word spoken between them, ready to move violently the moment the messaging becomes contradictory or confused. Then there's the variable nobody planned for, the one reshaping Japan's entire financial calculation in real time. Japan imports approximately 95% of its energy from the Middle East. The ongoing conflict involving Iran has pushed oil prices sharply higher. Higher oil prices mean higher import costs for Japan. Higher import costs mean higher inflation. Higher inflation means more pressure on the Bank of Japan to raise rates faster than it otherwise would. Faster rate hikes mean accelerated carry trade unwind. A war in the Middle East is now a direct input into global financial stability, and the transmission mechanism runs entirely through Tokyo. The BOJ itself warned in its most recent statement that CPI inflation faces renewed upward pressure from rising crude oil prices, and its hands are tied in ways no other major central bank faces. Prime Minister Takaichi is simultaneously navigating a diplomatic balancing act with the United States, meeting President Trump to discuss economic and military cooperation after he initially urged Japan to deploy warships to the Strait of Hormuz before retracting the demand. Japan is being pulled in every direction at once. By inflation, by energy vulnerability, by a record spending agenda, by a central bank trying to exit decades of emergency policy, and by an American president making military demands it cannot easily refuse. All of it is connected, and all of it flows directly into whether your savings are worth more or less 12 months from now. Here's what the data says about the timeline ahead. The Bank of Japan held its key rate at 0.75% at its March 19, 2026 meeting, the highest level since September 1995, in an 8-to-1 decision, with one board member dissenting for the second consecutive meeting in favor of an immediate hike to 1%. That sustained dissent is the institutional signal that the next move higher is not a question of whether, but when. Most Japanese economists expect the next hike in October 2026, but a weaker yen accelerating import-driven inflation could pull that forward to the second quarter of this year. Major banks on Wall Street are forecasting the next hike by June, followed by a path that takes Japan's policy rate to 5% by the end of 2027. The IMF has stated plainly that Japan is appropriately withdrawing monetary accommodation, and that rates should continue moving toward neutral. The direction is clear. The pace is the only variable still in debate. The scenario everyone is hoping for is slow and orderly. If Japan can normalize rates gradually with clear communication and no sudden shocks, the carry trade can unwind in a way that is manageable for global markets. But sudden shocks to the yen, an unexpected rate decision, an oil price spike, a political statement that spooks currency traders, can trigger a swift reversal that harms stock and bond markets worldwide simultaneously. In August 2024, the BOJ raised rates unexpectedly, and the Nikkei fell over 12% in a single session, while the S&P 500 corrected 6% in the days that followed. That was a warning shot. The carry trade was smaller then. The positions are larger now. The consequences of a disorderly unwind in 2026 would be proportionally greater. The three numbers you need to monitor from this moment forward are straightforward. USD JPY, currently trading between 147 and 149. With late 2026 forecasts clustering around 144 to 148 as the interest rate differential between the two countries continues to compress. A move below 145 signals carry trade stress. A sustained break below 140 signals crisis conditions. Japan's 10-year government bond yield currently at 26% and rising, with a break above 5%, triggering repricing in bond markets globally. And Bank of Japan meeting dates. April 27th and 28th is next, with June increasingly live for the next rate move based on current inflation data. Japan does not need aircraft carriers. It does not need nuclear weapons. It holds $1, $225 trillion of U.S. government debt, $12 trillion in global foreign assets, and $281 trillion in yen derivative positions that the entire world is sitting on top of without fully realizing it. The yen carry trade has been the fuel of the global bull market for a generation. When it unwinds, and it is already unwinding, it creates a liquidity vacuum in New York, London, and Hong Kong simultaneously. The only question that matters for your money right now is whether the 9 people in that Tokyo boardroom, fighting inflation, a record debt load, a geopolitical energy crisis, and a prime minister who wants cheap money indefinitely, can make this transition orderly. Because if they cannot, the next shock does not stay in Japan. It does not stay in Asia. It does not stay in the bond market. It arrives everywhere at once. Watch Tokyo. Nothing else matters more right now.